50 years ago, America went through the perfect financial storm. Inflation was surging, oil prices were exploding higher, and the economy was slowing down at the same time. For most people, that period meant stress, uncertainty, and falling purchasing power. But for the people who understood what was happening, it also created one of the biggest wealth-building opportunities of that era. And now in 2026, we are seeing a very similar setup begin to unfold again. History never repeats perfectly, but it absolutely rhymes. So in this video, I want to break down what happened back then, which types of investors came out ahead, which types fell behind, and most importantly, what that means for you right now if you want to position yourself the right way. Because when people look back at the 1970s and early 1980s, they usually just think about economic pain. They think about inflation, recessions, high gas prices, and financial fear. And yes, all of that was real. But what most people miss is that periods like this also create huge transfers of wealth. Money does not disappear. It moves, it leaves weak areas and flows into strong ones. It leaves the uninformed and goes to the prepared. And if you can understand where capital is moving before everyone else catches on, that is where the opportunity is. If you want more content like this, join the Wealth Academy in the link in the description. Now, before we talk about the opportunity, let's quickly go back and understand what actually happened around 50 years ago. In 1971, President Richard Nixon took the United States dollar off the gold standard. That was a huge turning point because it changed the way the monetary system worked. It gave the government and the Federal Reserve much more flexibility to create money and expand spending. In the short term, that can feel good because it boosts activity and liquidity. But over time, it also plants the seeds for inflation if too much money gets created relative to real economic output. Then in 1973, you had a major conflict in the Middle East, and that contributed to a huge spike in oil prices. Once oil moves higher, that creates ripple effects across the whole economy because oil is not just gasoline. It impacts transportation, manufacturing, shipping, logistics, food costs, and the price of doing business in general. So now you had rising inflation from monetary expansion, and then you had even more inflation pressure from an oil shock. That made the problem much worse. Then the Federal Reserve responded by raising interest rates aggressively through the late 1970s and into the early 1980s. And that is where the next part of the pain came in. Higher rates can help cool inflation, but they also put pressure on the economy. They raise borrowing costs, slow business activity, and hit the job market. So now you had inflation, energy pressure, and economic weakness, all hitting at once. Fast forward to today, and the parallels are hard to ignore. After the pandemic, we saw a massive wave of money creation and government spending that fueled a major inflation problem. Then in 2026, the United States became involved in conflict in the Middle East, and that added new pressure to oil markets. So once again, we have inflation concerns, energy concerns, and growing concerns about what happens next to the economy and labor market. And now the job market is already facing another huge disruption because of AI. So this environment is not identical to the 1970s, but it is similar enough that the lessons matter. The big question now is what happens next? Does the Federal Reserve keep leaning toward cuts because growth is slowing? Or does inflation and energy pressure force policymakers to stay tighter for longer or even turn more hawkish again? Nobody knows exactly how it plays out. But we do know this: when the system gets unstable, money starts rotating aggressively, and that is when fortunes are made by the people who understand the game. So let me simplify this by breaking investors into three different characters. Character number one is the person who consistently invested in the S&P 500. Character number two is the person who just saved cash and tried to play it safe. Character number three is what I call the opportunist, the investor who looked for specific sectors and assets that could benefit from the environment. Let's start with the period from 1971 to 1981. Assume each person put aside $100 a month. Over that decade, they would have contributed about $1,300 to $200 in total. If that money went into the S&P 500, the value would have grown to around $21,500. On the surface, that sounds good. You put in a little over 13 grand and ended up with over 21 grand. But there is a problem. Inflation over that same period was around 124%. So yes, you made money in nominal dollars, but your cost of living rose even faster. In real terms, you were still losing ground. Now let's look at the saver. This person also put aside the same $100 a month, but instead of investing, they kept it in the bank. During that era, interest rates eventually became very high, so savings rates were much better than what people are used to today. That means their cash did grow. In this example, it grew to around $20,000. Again, not bad on paper, but it still underperformed the S&P 500, and more importantly, it still did not beat inflation. So even though this person felt safer, they were still losing purchasing power. Then you get to the opportunist. Let's start with gold, because gold was one of the biggest winners of the early inflationary phase. If that same $1,300 had been invested into gold, it could have grown to around $4,500 by 1981. That absolutely crushed the stock market and crushed the savings account over that first decade. This is where people get excited and say, okay, that is the answer. Just buy the inflation hedge and you win. But this is exactly where investors get trapped, because one good decade does not automatically make something the best long-term strategy. And if you do not understand what you own and why you own it, you can make a great trade and then ruin it by overstaying. So now let's extend the timeline and look at 1971 to 1991. Same idea. Let's assume you kept investing that $100 a month for a full 20 years. Inflation over that longer stretch was around 236%, so the hurdle was even bigger. But now look what happened. If you kept buying the S&P 500 consistently through all the volatility, recessions, inflation, and fear, your money would have grown to over $133,000. Now you are beating inflation in a meaningful way. That is the power of long-term ownership of productive businesses. What about the saver? Over the same 20 years, that cash would have grown to roughly $60,000. That is better than nothing, and it feels stable because you never see big drawdowns the same way you do in the market. But even then, you still lost a huge amount of real value versus inflation and versus what productive assets delivered. Now look at gold over the full 20-year stretch. If you kept buying gold all the way through, the investment would have been worth around $52,000 by 1991. Think about that. Gold was the superstar in the first phase, but over the full 2-decade period, it ended up lagging even the saver. Why? Because gold tends to thrive when people are losing confidence in the currency, the system, or the outlook. But once policy shifts, interest rates rise, and that fear begins to cool, gold can stall out or even collapse. So if you bought it at the right time and sold into strength, you looked brilliant. If you treated it like a forever growth engine, it disappointed badly. And this is the lesson most people miss. The right asset depends on the phase of the cycle and on your strategy. There is no magic ticker that works all the time in every environment. There are assets that work best in specific conditions, and your job is to understand those conditions. That is why strategy matters so much. Most people today have no real strategy. They chase what is hot on television, on social media, on Reddit, or on whatever headline is trending that week. They buy after a move has already happened because they feel the fear of missing out. Then when the asset finally pulls back, they panic and sell because they never actually understood what they were buying in the first place. That is not investing. That is emotional reaction disguised as investing. Real investing starts with understanding the asset. What business are you buying? What cash flows are you buying? What risk are you taking? What environment helps the asset thrive? What environment hurts it? If you cannot answer those questions, then you do not have conviction. And without conviction, you are likely to buy high and sell low. This is why I always come back to a simple principle. Do not just think about the stock. Think about the business and the system around it. If you own gold, understand that it is not the same thing as owning a productive business. Gold does not innovate. Gold does not grow earnings. Gold does not reinvest capital. Gold is a hedge, a store of value, and in many cases more of an alternative savings vehicle than a true compounding machine. That does not mean gold is bad. I think gold absolutely has a role, but you need to understand the role it plays. For me, gold is an inflation hedge and a monetary hedge. It can protect purchasing power during certain periods, and it can do very well when trust in the system is weak. But I do not look at it the same way I look at owning great businesses. Productive assets and hedges are different tools. If you confuse them, you can easily use the wrong one at the wrong time. Now let's bring this back to today, because this is where the opportunity gets interesting. If we are entering a period where inflation stays sticky, oil remains elevated, geopolitical tensions remain high, and growth starts slowing, then certain industries will likely benefit more than others. This is where the opportunist mindset becomes powerful. Not because you randomly gamble on whatever is moving, but because you identify which areas of the economy are positioned to gain from the current environment. When energy prices spike, who benefits? Energy producers, oil services, pipeline operators, and related infrastructure businesses. When geopolitical conflict rises, who benefits? Defense contractors, military technology firms, cybersecurity companies, and certain strategic suppliers. When supply chains tighten and shortages hit, who benefits? The companies controlling scarce inputs, critical infrastructure, and bottleneck resources. And then you have the AI side of this equation, which is also massive. A lot of people keep focusing only on the obvious names, but the real opportunity is often in the backbone. The semiconductors, the data center infrastructure, the power demand, the cooling systems, the networking equipment, and the commodity inputs required to keep those systems running. AI is not just one app or one chatbot. It is an entire stack, and regardless of which consumer-facing platform wins, the underlying infrastructure still has to be built. That is why this environment can create huge winners, but only if you are willing to do the work. The opportunist does not blindly buy hype. The opportunist studies the flow of money. The opportunist asks where the pressure is building, where the demand is non-negotiable, where supply is constrained, and which businesses have the pricing power, relevance, or strategic position to benefit. If you are just a saver, you have to understand the trade-off. Yes, you are taking less volatility, but you are almost guaranteed to lose purchasing power over time. Inflation quietly taxes idle cash, and that is not something that only happened in the 1970s. It has been happening for decades. A high-yield savings account can help, but it usually does not fully solve the real problem. If you are a broad market investor, that is still a very strong path, especially if you are consistent and truly long-term. History shows that owning great businesses over long periods can be one of the best ways to build wealth. But you must think in decades, not weeks. The people who won were not the ones who checked every dip and panicked every time the market got ugly. The winners were the ones who kept buying productive assets through the chaos. And if you are the opportunist, then you have the potential to outperform. But that comes with a responsibility. You need research. You need discipline. You need to understand what phase you are in. And you need to know when an opportunity is maturing versus when it is just beginning. Because the biggest mistake opportunists make is buying after a huge move with no plan and then getting shaken out the moment volatility hits. That is why skill matters so much in this environment. The economic system is designed to reward people who understand capital allocation, business quality cycles, and positioning. If you do not learn those things, you end up competing against people who do. And when that happens, your money becomes their opportunity. At the end of the day, the lesson from 50 years ago is not that one asset always wins. The lesson is that different environments reward different behaviors. Savers feel safe, but inflation erodes them. Long-term investors and productive assets can do very well, but only if they stay patient through volatility. Opportunists can do even better in the right phase, but only if they understand what they are doing. So the question is not just what stock should you buy. The question is, what kind of investor are you going to be? Because this shift happening in 2026 is not just another headline cycle. It is another test, another period where fear will dominate the average person, while preparation can reward the disciplined. If inflation stays elevated, if oil remains under pressure, if policy gets trapped, and if markets keep rotating, then this may end up being one of those rare windows where the financially educated separate themselves from the crowd. So do not waste this moment just reacting emotionally. Study it, learn from history, understand the businesses, the sectors, and the money flows. Build your strategy before the crowd fully catches on, because wealth is rarely built by accident. It is built by people who understand what game they are playing and position accordingly. If you got value from this video, share it with a friend, family member, colleague, or another investor who needs to hear this. And if you want to go deeper with me, get the exact stocks I'm buying, exclusive weekly videos, and deeper market research inside Wealth Academy, click the join button below or the link in the description. Invest in yourself, level up your skills, and put yourself in a position to build real long-term and generational wealth.